take us back to your early days as an investment analyst, Jason. And there was that little known company way back in the day called Stantec. And what was the discovery process there very early on?
Well, so I'd worked in Asia for about 10 years before I came home, right? And I worked for a place, a research house that was great at, stock picking and picking winners. And when I first came back to Canada, I went back to Calgary initially because that's my hometown. Then I moved on to Toronto about a year and a half later. But I'm looking around for great companies in my own backyard, and I found this teeny wee little company with $85 million market cap called Stantec, based in Edmonton, right? And so that was the first report that I ever wrote. And I think when you did the interview, I may have showed you, like I still have it, because I was working for Acumen Capital Partners who are still going. So I wrote this report on this company called Stantec. And it is cool to think that I wrote that report in, what year would I have written that report in? Probably 1999, 2000. And if you pull up a share price from 1999, and if I just put $100 into that stock and held it all that time, right, I could kind of retire. So there are these, your show to some extent is about compounders. There are these great compounding stocks that just go on and on and on and on. And if you're lucky enough to find them and not keep trimming them, because that's one thing is with the compounders, you gotta let your winners run. So that was
That's what people love about you, right? It's that you can discover these companies early, but you're willing to take a risk and bet on companies early too. Another example is Constellation Software.
Yeah.
I had a podcast recently, Jason. It's up on YouTube now with Jerome Haas of Lightwater Partners.
Yeah.
He said he bumped into you years ago at a conference, and this was when Constellation Software was at $70 per share.
Right.
And Jerome was talking with you, and he was saying, "Hey, I'm going to place a short on Constellation Software," and you said, "Don't do it." You warned Jerome, don't short Constellation Software. It's got the longest runway probably ever. But at that time, that may have sounded ludicrous, right? You're betting on a company that, in hindsight, is one of Canada's best run, maybe the world's best run companies.
Yeah.
Today, it's gone from $70, and today it's $4,700 per share.
Yeah.
So what led you to the discovery of Constellation and just having the conviction when people didn't?
I don't think with any of those like multi-baggers, right? And another one that a new multi-bagger is in the news today, which is Vital Health, and we can talk about that later, right? But I don't think you realize on day one how good those companies are. You get into them and say that it's good enough to own right now. So for the next 12 to 24 months, everything looks good, and then another 6 months goes by, and you sort your stocks from top to bottom, and you realize it's still in your top 5 or 10 in terms of attractive qualities that you're looking for. And then 5 years later, 10 years later, you're still saying it still keeps floating to the top. And I tell people, even today after the huge run in the stock, if you could only have one stock in the Canadian market, it'd be Constellation, because of the combination of, on one side, the positive, which is the growth and the margins, but on the flip side is the balance sheet strength and the diversification of the business model within the company.
Talking about balance sheet strength, I think it still has the same 21 million shares. There's been no share dilution.
No new shares.
Yeah.
They generate cash flow so fast that they're often unlevered, right? They're more than capable of taking on debt, but they just can't find things to buy fast enough. The margins are typically over 20%. And it's just, also as a company that is predominantly operating outside of Canada for the last couple of years, the growth rate has been bumped by the translation of all their international earnings in currencies that are stronger than the Canadian dollar.
So 2006, I think May 2006, Constellation Software IPOs. At what point did you learn about it, Jason, and took an interest?
I found it right away, actually. I found it with a month because it didn't do a real IPO. It was a forced IPO because the big pension fund that had backed them, Amers or Teachers, required that they go public. Mark didn't want to go public, right? And so it went public with no fanfare, no raise, and no liquidity. And so that was a stock where, honest to God, to buy $10,000 of stock, it might take you 3 weeks. There was virtually no float out there, right? And then the numbers looked phenomenal because the stock was trading on like 5 times earnings, right? And it had 25% growth, strong balance sheet. And I remember pointing it out to a couple of my friends, and I won't mention them by name, and their reaction was, I can find companies like that all over the place. Because it was a market cap at that time when it went public was about $500 million. It had a $500 million market cap on day one. with no fanfare, no publicity, no investor relations stuff, just Mark's annual letter. And so I built a little position in the company, and then I called up Mark and asked if I could have a meeting, and he said, "Yeah, sure." I come over, right? Now if he tried to get a meeting with him, it's easier to get a meeting with the Prime Minister or the President of the United States than it is with him. He's just he's got the whole Moses beard thing going, and so I don't know what that's all about. But he had so little, there was so little interest from the capital markets that he wasn't like badgered with people coming by. And so I show up to the meeting, and I don't know if you've ever met him. He's about 6'4", and really used to be really into working out and rugby and stuff. And I walk in, he's got an Under Armour. It's in his office. He's got an Under Armour golf shirt on that looks like it's slightly damp, like he finished his workout a half an hour earlier. And he walks and says, "Okay, you got 30 minutes." He was a no nonsense guy, but he answered all my questions, and away I went. And I met him a few more times. I got his AGM, but now he's made himself. He's really removed himself from that kind of stuff. He does his annual, his annual stuff, but I don't even know if he shows up at his annual stuff anymore. So it's like, this is not a criticism, but just to show you, like, this was such an odd duck for the first couple of years. But I'd write about it in my newsletter, and people would start paying attention, and I'd say, these are the best capital allocators that I've ever seen. And then I also was playing Masters lacrosse at that time. So this is around 2010. I was in an over 50 tournament or something in Florida. I was talking to this guy, and we were having a beer after the game kind of stuff, right? All a bunch of sweaty over the hill weekend warriors kind of, and so they go, "What do you do?" He said, "Oh, I work software." I said, "Oh, which company were you?" He goes, "You probably never heard of it before, but he said, "Oh, yeah, he didn't realize it's from Canada. It's called Constellation Software." I go, "Constellation Software?" I own a whole bunch of stock, and I met with Mark, and so he started telling me about his experience. He had sold his company to Constellation, and then Mark had asked him to stay on for a couple of years, in transition to run it, and then when that 2 years came up, and somehow he got stock in the deal, right? And when the 2 years was up, he said, "Mark's paying me extremely well. I love working for this guy, and the stock that I think he got partially paid in stock or whatever." He said, "It just keeps going up." Right? And I said to him, and then I told him what I thought of the company kind of stuff. So this was a guy who sold his company and could have moved on, but he didn't. But he told me a lot of the stuff about the split between R&D and philosophically of how they look at companies and how they clean them up and all that kind of stuff, right? And so I just thought, yeah, and the reason why he's buying cheap is he's not buying high growth companies. He's buying relatively high margin companies and then just taking those cash flows and buying more of these. He's just buying more cash cows. The growth rate from the company in any given year, the true growth rate is anywhere between flat and 5%. So he's not buying growth companies, but he's buying a lot of mature SaaS businesses cheaply that are throwing off a lot of cash flow.
Interesting. Your strategy today at DCAM, is it still very much that high ROE pillar? Is that where you start, and these are the companies that you focus on, high return on equity?
Generally, yes, but I would make a couple of adjustments here. A lot of the companies that we like and that you like have a growth through acquisition component to them, right? So what ends up happening is the balance sheets kind of get distorted, right? So that when you look at the return on equity of Constellation or Descartes or companies like that, it's really hard to calculate the ROE without going back in time and making a ton of adjustments. So you can do it, but it would take you a couple of days if you were really good on accounting, and maybe a week if you weren't, to really figure out what the true return on equity is now. And so certainly in the tech world, we've moved to a new metric that's easier to calculate, and that's that rule of 40, which is when you're looking at a company and you look at a combination of the profit margin and the sales growth. And so that's more what we lean to now, just because we can't calculate the ROE on companies without doing a ton of work. Because when you're amortizing intangibles, right? You buy a company for $5 million and $4 million of its intangibles, so you write off those intangibles, so there's only $1 million there. It makes the ROE look really, really high, but it's not really accurate in terms of what you paid, and yet, because even though there's all those intangibles, it doesn't mean that it's a worthless company that you overpaid. It just means so much of its value is built up in its brand and its knowledge and its service reputation and things like that, as opposed to something that's an actual hard asset, right? So that we use that rule of 40 as a good benchmark. So when I'm looking at companies, I say, okay, there's 1,000 companies I can look at today. I'm really screening off of 4 factors to get myself down to maybe 10 companies to take a closer look at. And when I do that, I go, wow, I already own 7 of the 10. So what's the deal with the 3 that I don't own, right? Something new's come on there. So I'm basically looking for revenue growth, right? So if I'm looking at a new company, I'm not very interested in a company that's not growing by 12% minimum. I'm looking for a profit margin, and it can be below 40, but it's got to be, because even better than owning a rule of 40 company is to find a company that's at a 20, but it's going 20, 24, 28. It's improving. It's moving its way to 40, right? I guess the factors I'm looking for: sales growth, margin, valuation. So those are the 3. And then the 4th one is a technical assessment of myself by just looking at the 1 and 5 year chart. And this is not like technical stuff the way like a guy like Mark Darriott does, where it's really complicated. It's just is it broadly speaking going from bottom left to top right? Because if I look back and say this company's been doing a lot of good stuff for a while and it's not showing up in the share price chart, then I can spend days to figure out why, and there is a why. You'll find out there's some reason why the accounting numbers look good, but the stock's not going anywhere, right? So that's the 4th factor. And so when I screen for those 4 things, I start with the technical, which is I'm only interested in looking at companies that are in uptrends, it's not a super just broadly speaking. I'm looking for a company that is going bottom left to top right, and there can be a little bit of chop and change in there kind of stuff. And over the last 5 years, the company ideally is kind of up, 85 to 90% minimum. So that it shows that on an average year they're compounding by 15% a year kind of thing, right? And all the rest of them I just ignore them. If they don't have a positive chart, it's like, right, because that looking at the chart really does add what I call a momentum aspect to it. If the company is just moving up gradually from bottom left to, and if you pull up a 5 or 10 year chart of Constellation, it's a work of art. But so is Descartes, right? VitalHub was a tricky one because it just went flat for the longest time because it was super small, and then eventually it's taken off. And they just did a financing last night or whatever at around $11, and I wouldn't be shocked if in 2 years' time it's a $20 stock, right? But you and I, you own VitalHub personally.
I do too. Yeah, I believe in it just as much as you do.
But your cost base and mine on VitalHub is probably down in the 2.5 kind of thing, right?
Yeah.
So probably 24 months from now, it's going to be for you or I, from where our cost base is, it's a 10 bagger.
Yeah.
So
it's just a phenomenal little company that just keeps on getting bigger, as you say.